Hello, everybody. Chris Martinson here, and today we're going to be talking about finance and economics as part of Finance U. Remember, anything that you see in this video and all resources available at our websites or affiliated websites are not intended as or construed as financial advice. This is for educational purposes. Remember, if you have a financial decision, please consult a financial professional. We are not attorneys, we're not CPAs, we are not financial managers. As well, we do our best to be accurate, and everything we represent is as accurate as we know it to be. Now, let's turn to our program. So we had this gold standard, that's Bretton Woods 1, and it made sense, right? I think the structure of it, intellectually, I understood why they did it. It made sense, right? At that time, post-war, a lot of shattered economies, you need a stable thing, we're starting to have global trade. It makes sense. The problem is humans, right, who can't help themselves politically from just spending a little bit more than they actually are earning. It's a very normal thing, right? Particularly when you have that printing press. So then that breaks August 15th, 1971, with the temporary suspension of the gold window, which is why when I hear them talk about like transient inflation, just grab your wallet. And
exactly.
and yeah, but it's gone on and on and on. And so one of the other things I'd like to talk to you about is how they've managed to keep this going long enough. My philosophy, and I'd love to get your take on this, is it's just been one shenanigan after the other. At first they had to intervene rarely and exceptionally because it was really important. It was a Black Tuesday in the market. It was a long-term capital management. And then that camel's nose got under the tent, Alistair. And then next thing you know, like they're intervening more and more regularly. Maybe I see a shadow under every bush now, but I'm pretty sure I see constant interventions in the markets now. I get the sense of just putting fingers in the dike all over the place, and maybe we have more leaks than fingers right now. But I don't trust the markets anymore. I think they've broken them. And my evidence for this, even if I can't give you the exact specifics, but I'd love a full audit down to the transaction level to be sure, but of the Fed. But you know what I see now? I open up my FinViz, I look at the indices, I'm looking at the Dow Jones, the small caps in the US, technology shares, the German DAX, the FTSE, all of them. They all trade tick for tick on a 5-minute scale. They all look exactly the same. I can't tell the charts apart if you delabeled them. They look the same on an hourly basis. They look the same on a weekly and a monthly basis. Like there's no difference. Japanese stocks, German stocks, small caps, they are now one market. And that's my prima facie evidence for these are not markets anymore. There's something else. What's your take on that?
Well, it's interesting. I mean, undoubtedly, markets are so intervened in. I mean, central banks, sort of currency stabilization funds, whatever you like to call it. I mean, they're intervening all the time. I mean, that is for sure. But the underlying problem is something which was not properly recognized going all the way back to the 1930s, and that is that there is such a thing as a bank credit cycle. And it's quite simple. I mean, if you start off with, say, normal times, bankers are normally quite cautious. They will look at things very closely, and they will, lend money on projects which they think are reasonably worked out. Of course, the expansion of credit makes the economy look just that much better. And that's perfectly valid. I'm not worried about that at all, as long as the credit is directed into sort of profit-making opportunities. And where they fail, the credit disappears, or the banks put it into bankruptcy, whatever. That is normal. You can expand credit quite a lot on that basis. But the problem is that bankers get a little bit enthusiastic with this, and then they start competing for business. Now, that's generally a no-no, because it changes the whole thing. They're trying to increase the leverage in their balance sheets, and they then find, by maybe reducing the rates a bit to try and attract, this customer who is strategically important in his sector. We must get him on board, sort of thing. So we will lend him some money. That sort of thing happens. And then inevitably the expansion of, call it slightly false credit, leads to prices rising, product shortages, you've got commodity bottlenecks, labor skill bottlenecks, all these things happen. And then, suddenly all the business plans are beginning to go awry. So, the bankers then think, and they do this individually, but they all do it all at the same time. They think, well, yeah, hold on, we're a bit exposed to this economy, and it looks like it's going to turn down. And generally, if these guys have been around a bit, they'll see that there's undue speculation in the markets. Like we have the Roaring Twenties, for example, before the 1930s. What was that? That was on the back of credit expansion, which for the first time was assisted by Benjamin Strong at the Fed, the first Fed chairman, who believed in, giving the economy a nudge with central bank currency. And, it looked fine until, of course, you saw the other side of the coin. And when banks, begin to recognize that there is something wrong with this, they start drawing in the horns. They try to reduce the leverage in their balance sheets. And the result is that you get a crash. And as to your point about interventions, what we have seen is continual interventions to try and stop this cycle from destabilizing the economy. And the problem is that every time they manage to stop it really destabilizing the economy, next time it's a damn sight worse. The problems just mount, because they're never washed out of the system. So eventually the whole thing just falls over. And we had a pretty nasty shock, really. Well, the first one was, I suppose, the dot-com bubble bursting. I mean, there was, I think the stock market halved on that. And then, of course, we had the Lehman crisis, property crisis. And the Fed just wrote an open-ended check to everybody, bail you all out. And it worked for a little while. I mean, that was 13, 14 years ago now. So actually, the Fed has been successful in that. But what it's done is it's stored out problems down the line. And that is what we're now addressing. And we're seeing, debt which was taken out at low interest rates when the Fed's interest rates was zero. The Bank of Japan's and the Eurozone's interest rates were negative. I mean, it's just crazy. It is crazy, absolutely crazy. But anyway, what do? You load up on debt. I mean, the banks are quite happy to lend money, particularly if you're doing something financial. If you're making something, that takes a little bit more understanding by today's investment bankers. They think, oh, I don't know. No, it's far easier to lend a hedge fund some money or something. That's so. The credit has expanded more in that direction, rather than in the direction of actual production. Wall Street has benefited, if you like, rather than Main Street, and so this is now beginning to unwind. And this is particularly noticeable in the area of derivatives. I mean, the first shock we had on this one was last year when we had a temporary prime minister in the sense of a free market loving lady called Liz Truss. And, she came up with this budget to try and stimulate the economy by, sort of cutting taxes, but without cutting public spending. And the result was that the gilt market took fright. And we then discovered that pension funds, I mean, would you believe pension funds getting into leveraged investments and doing things like that? I mean, this is not what a pension fund should be doing. But on the other hand, when sort of a government security, a gilt, yields 0.75% or something, and they've got liabilities out there, going on for, sort of 30, 40 years, tied to final salaries, which is the case with quite a lot still, then under those circumstances, I mean, they just cannot meet those obligations. So what they did was they started doing interest rate swaps. Now, they called it something fancy, liability-driven investment. Which
sounds good.
Don't ask. But what it meant basically was that they could gear up the return on the gilt market. So, if the gilts were paying say 2% or something, they could gear it up, 4 times to 8%. And then you're beginning to meet your long-term liabilities. But the way you did it basically was on a geared interest rate swap. An interest rate swap is really quite simple. You get two parties. One wants a fixed rate and the other wants a floating rate. And so they come to an agreement that, in return for me getting a fixed rate, you have the floating rate and you will pay me the fixed rate. And that way, I can begin to have some certainty in my income stream. And if we leverage it up, then that's lovely. But within this contract, which is a standard contract, it's set by the ISD, the International Securities and Dealers Association, standard contract. When the interest rates rise, you find that the fixed rate is below the floating rate. Now, what that means is that in terms of collateral, with the fixed rate, you have to send collateral over to the floating rate provider. And this suddenly happened in the gilt market. The gilt yield started rising quite sharply. I mean, very, very sharply. And the result was that pension funds were having calls which they had to meet on their liability-driven investment schemes. And so they would start selling gilts off to basically meet these calls. And now what we have a year later is, I mean, it won't have escaped anybody's interest, I hope, that bond yields everywhere are just shooting up, and government bond yields at that. I mean, it was interesting that last week when the Fed came out, or the FOMC committee came out and said, we're just pausing on interest rates. Now, you would have thought that with yields on the 10-year US Treasury note having risen very, very strongly ahead of that, you would think that it would have come off. It didn't. It went on up. Now, the reason for that is quite simple. The world has got an enormous amount of these interest rate swaps. According to the Bank of International Settlements, at the end of last year, the notional value of these swaps was $400 trillion equivalent. 400 trillion. Now, I mean, it's a mind-boggling amount. It really is. When you think that the US economy is about, 27 trillion, we're talking about 400 trillion. Now, admittedly, on an interest rate swap, you do not involve the, if you like, the headline number of 400 trillion. You involve a fraction of it. But you can easily see that what is shifting here is maybe 5 to 10 trillion dollars equivalent around the world of collateral, which is having to go from the fixed end, if you like, of the swap, which is way underwater with the floating rate way above it. They're having to just come out with increasing amounts of collateral into the floating rate side. So this is, I think, what is really driving markets, and it's a bit of a doom loop. We've had a pause today, which is always very, very welcome. But I mean, it really does look to me as if these rates are going to go a hell of a lot higher because the system's falling apart, Chris. I mean, that's the other way to express it.
Hello, Chris Martenson. I'm the CEO of Peak Prosperity and also Peak Financial Investing. And after watching that, you're probably wondering, well, what do I do with my money? Look, you both deserve and need somebody who can talk to you about what's really going on in this world, understand the situation as it is, not be steering you towards certain things that don't make sense for you or just keep you in a game that's already ended. Look, if you want to talk to somebody about the petrodollar declining or what is happening with gold or which sectors are actually the best ones to be in, given what the Federal Reserve is up to or the federal government, you deserve to talk to somebody who can answer those and has a few gray hairs and has been there through some of the economic cycles because, hey, we're in another economic cycle, so it's good to have that experience. Fortunately, at Peak Financial Investing, what we do is we go out and we scour and we look for the very best firms out there who satisfy one thing above all else. They've got great experience coupled to great customer service. So if you want to come by peakfinancialinvesting.com, there's a very simple form you can fill out. Just a few fields, you hit send, What happens is an email gets triggered out. It goes to an endorsed firm of ours. You will get an email back. You can then set up a phone call for a 30 to 45-minute free, no obligation, no pressure call to find out if this firm is a good fit for you and to find out if you're a good fit for the firm. It has to go both ways. And if all that matches up, this will be one of the best things that could happen to you this year. So please come by peakfinancialinvesting.com. Very simple process. We would love to help you if we can. Thanks very much.